Did you hear that investors suddenly tried to pull over $1 billion out of a major investment fund? And the fund said no? That's exactly what just happened with BlackRock, and it's raising concerns about a massive $3 trillion market most people have never heard of. Private credit. Private credit is basically when giant investment firms lend money directly to companies instead of banks doing the lending. Over the last decade, this market exploded. Huge firms like BlackRock, Apollo, and Blackstone now lend hundreds of billions of dollars to mid-sized companies around the world. But there's one big problem. These loans are extremely hard to sell quickly. Recently, investors tried to withdraw more money from one BlackRock private credit fund than the fund allows. But the loans inside the fund can't be sold overnight. So the fund limited withdrawals and delayed some investors from taking their money out. This type of restriction is called a redemption gate, and it exists to prevent a panic. The bigger concern is that private credit defaults are starting to rise. Many of these loans were made when interest rates were near zero. But today, borrowing costs are much higher. Some companies are struggling to keep up with their payments. But here's the part many people don't realize. When companies can't pay, lenders often don't call it a default. Instead, they extend the loan, add the unpaid interest to the balance, and push the problem into the future. This practice is sometimes called extend and pretend. That means losses in private credit can stay hidden for years. And if the economy slows down, those delayed defaults could hit the system all at once. Which is why some analysts are starting to watch this market very closely.